We have Larry Shover in the pits of the CME. Larry Haverty giving us two derivative plays coming off the housing comeback, and Jamie Cox telling us why financials are going to be the biggest beneficiary from the consumer resurgence. Let us start with Larry at the CME. What a day, Larry. First of all, we had the housing construction up 15%. The yields on the bonds, as we just heard from Liz, way down, which is all good signs. Are we going to see this market continue to climb up?
You know, I think so. Take this morning as an example. Market naysayers came out with both barrels blazing, trying to push this market down, especially with tech. And then we got a splash of headlines coming out of Europe. We have better than expected housing data that came out. All the while, as you mentioned before, IBM down over 5.5%. That's 75 points in the Dow and 1 point in the S&P. They could not push this market down. Right now, it's macro-focused, not micro-focused, and I think we just need to stay in right now for the ride.
Are there more positives out there than negatives, finally? You know, we got the good housing numbers that have been put together. Consumer sentiment seems a little better. We saw good retail sales numbers a couple of days ago.
Yeah, we've seen good numbers there. We've seen stabilizing numbers in China, and I think the market continually underestimating the tailwind that good housing numbers could have for our economy. And so with that in mind, I think the market's going to continue to march higher, but shrouded in all that is an immense amount of negativity in the market. Nobody believes that this market can go higher given fiscal cliff issues, given that Spain might say no, and all the variety of other reasons, but we are marching higher, given to the point that you just made earlier.
Well, given all that, Larry, I'm surprised then, and I suppose you are too, at what happened to IBM and Intel, no?
I'm very surprised, down 5.5% at last glance. The market's looking right beyond that, and I think the fact is we're writing off quarter three, we're writing off quarter four. The top-down number for S&P 500 stocks is $105. The bottoms up is $115. $10 of reductions already baked into the market, given the fact that we're at 1.5 GDP growth. So the market's rallying on all this bad news. So we have a lot of room for
Larry, just to finish up on that, is IBM then a buy at 200?
Well, IBM for the long term is a buy only because option volatility is so very cheap right now. IBM is trading below the 10 percentile over the last 3 years. So if I owned IBM, I'd be very, very conservative and own option premium against it to protect the downside risk.
All right. Okay, stay there, Larry, if you could, because we want to bring in Larry Haverty.